business or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to the Modern Financial Advisor podcast, brought to you by Truelytics, the one and only comprehensive advisor transition management platform. This week on the show, I have Natalie Wolfson, the CEO of AssetMark, with me to explore the changing landscape for investors. Natalie sheds some light on some really fascinating dynamics that are likely to have a big impact on your business, such as what younger investors expect from their financial advisor, or how technology and outsourced providers are enabling advisors to scale rapidly while removing friction for their clients. It's fascinating stuff. Natalie is amazing. You are absolutely going to love this episode of the show. Now, before we get to the conversation with Natalie, please do make sure you subscribe to the podcast on Apple Podcasts, Spotify, Stitcher, SoundCloud, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a guest or a topic for the show, hit us up, podcast@truelytics.com, or swing by the website. Use that little contact form or click on Ian Carnell's face down in the bottom right-hand corner. He loves to hear from you, okay? Let's get to our conversation with Natalie Wolfson. Natalie Wolfson, so wonderful to see you. Welcome to the Modern Financial Advisor podcast.
Thank you so much for having me. I'm so excited to be here.
This is great. So, and by the way, it's Friday before a long weekend when we're recording this. So it's just awesome. I think everybody's in a better mood when they know they got a 3-day weekend coming. So yeah, we're going to crush it today.
You're not kidding.
You know, we're feeling it big time in our house. My daughter just started running track and she had her first track meet last night. And at the early part of the day, it was like 60 something degrees out. We're like, this is awesome. It's gonna be an amazing day. We got to, the temperature just started dropping like a stone and the wind came. And so we're just all wiped out this morning. We're all like, we had a miserable time. So this weekend.
How did she do? She do?
She did really good. So she's 7th grade. So they start out, they get kids doing a whole bunch of different events. So she did shot put, which she's 5'2". She should not be doing shot put, discus. And then she ran the 800 and the 400. She placed 3rd in the 400, which is awesome, but she will not be throwing things.
You know what? I am also 5'2", and we can do anything we want. If she wants to be a shot putter, she can do it.
She's a mighty mouse. Well, she did actually pretty good on the discus, right? So I did discus in high school. So I was like, at least I had the ability to, like, honey, let's go practice. I bought a practice one and we went up to the field and we kind of worked on it and so forth, just to kind of give her some form of thought. So she did great for her first timer. She did awesome. So very proud of her. We all survived I'm in Austin, Texas. You know, we do not do 30-degree weather very well, especially when it's windy, and none of us were prepared. It was terrible. It was awful. The whole place was miserable. Oh my gosh. Well, you know, look, I'm looking forward to getting you into this conversation together because, you know, we were put together and talking about, like, you know, listen, Natalie can talk about some really interesting things that are happening in the industry. And so in our prep call, we had this great kind of like session of just you and me like brainstorming things. And one of the ones that was really fascinating that you brought up was a changing landscape for investors. And, you know, particularly young investors, millennials and Gen Z, they're really in high demand for the industry right now. And wealth management firms are like, hey, we need to get the next generation of wealthy folks. And it's funny. It always kind of surprises me when you think about it. Many millennials are in their 30s now. They're having kids.
The oldest are 40. The oldest millennials turned 40 this year. Yeah, it's crazy. You know, and it's interesting. We were talking about new investors, and I think sometimes people bundle millennials and Gen Z together, and they could not be more different. Their experiences have left them in completely almost opposite spaces. So millennials, they had 2 big market dislocations. They're categorized by an environment of high polarization. They're very hesitant with the market and very hesitant to take advice. They look towards their networks, they look towards their communities for advice, and they got into investing really, really late as a result of their experience. And then, you know, Gen Z, 15% of investors are new as of 2020. And that's Gen Z, 15%. Schwab did a great study on generation investors, and 82% of those new investors want advice. So they're seeking advice, they're seeking out the markets, they're really interested in investments, and not just traditional investments, NFTs, digital assets, these are highly experimental, highly risk-seeking investors. So very, very different from millennials, in my view.
I'm so glad you brought that up because, I'm 49 years old. So like I'm a Gen Xer, and it is right. Like sometimes you start to think, and I think many of us in the industry are a little guilty of this. You think of millennials and you think of young kids. It's like, no, they're adults now, right? And to your point, like their life experience of when they became an adult, that millennial at 2000-ish, that's why they call millennials, right? And their adult lifetime has had some tumult in it, right? They've seen market corrections. They've seen a real estate crash, a bubble. They've seen a great recession where many of them were starting their career off and like getting their butts kicked. So life is dramatically different. That shapes your worldview, right? It's definitely a dramatic thing.
It's absolutely true. And these younger, I'll say younger investors, I'm Gen Xer myself too, but they're just very different. And so as an advisor or as someone who serves advisors like AssetMark, we have to treat them differently.
Yeah.
And I think the generation, the youngest generation, Gen Z, such an opportunity for the market. I think they're going to push us.
Yeah.
Just like millennials did. Millennials pushed us to be more digital and more interactive. This Gen Z, they're going to push us to be personalized. They're going to push us to be thinking about portfolios and investments differently. And that's fantastic. It makes the industry better.
I love this conversation for that reason. The expectations of a segment of advisors, right? So we had a conversation on equity and inclusion, diversity, equity, and inclusion on this show. And I am blanking on her name. I don't know why. I will work it into the show notes. Laura something, Laura Gregg. Anyway, we had this whole conversation about diversity, equity, and inclusion on the show. And it was fascinating to me as, I'm kind of like, I look like the average advisor, right? The average advisor is a middle-aged white guy, right? Mm-hmm. As a general rule, and not to, too much Peter Rutter, but they're older than me on average. But it's a really interesting thing to start to think like, hey, if for the future of your business, the opportunity for your business is to look outside of people who look like you, right? So the demographics of America are changing from that diversity, equity, and inclusion perspective, but they also are changing from a generational perspective, right? So the new wealth will be millennials, and then coming right behind them, Gen Zs. If you're going to have a firm that lasts for another 20 or 30 years, you must start thinking about marketing and attracting and then serving those client bases, right?
That's absolutely true. And while, as we age, there are certain things that change about us. We're more concerned about the long term, more concerned about leaving a legacy, more concerned about our kids' education. More concerned about saving versus adventures. These are the types of things that change regardless of generation. Even so, these younger generations are quite different from the standard advisor profile. And all of us in the industry need to embrace it. They want to make an impact, and they view their money as a way to vote with their feet. And they want that kind of impact on the world. They care about the environment. They care about inclusion. They care about creating a better world for the next generations than the one they inherited. And it's one of the primary decision factors. It's not, hey, I'll make a lot of money and then I'll give what I can. It's, I want to give with everything I do. Yeah. And it's fantastic. It's a fantastic thing about the millennials and Gen Z share in common, actually. And I would argue Gen X too.
Yeah.
We're very focused on making an impact.
Well, it's interesting when you start to think about your own self, like, so you may be Gen Xers, you start to think like some of it is your mindset has changed, right? Over the years, like, hey, I wasn't aware that I should be thinking about making sure my money isn't going to companies that are like polluting the world, as an example, right? Like maybe I should shift away from this industry and focus more on the future, as an example, like, investing in a Tesla or cars that are other companies that are wind energy or something like that. Like these things are important to me. The environment, my children are going to inherit it. My grandchildren are going to inherit this world. Maybe I should start thinking that way. Whereas, when we were younger, maybe you didn't think that way. You're just like, this money's going in a mutual fund and hopefully it gets a great return.
Yeah. Right? It's interesting. I think two important things have changed. One is there was a time, maybe even just 4 or 5 years ago, where people believed you either invested for impact or you invested for returns.
Yeah.
And so you'd be giving up returns if you invested for impact. That has been, with the ESG research, has been debunked. That belief has been disproven. And so I think that's an important thing for those of us who were thinking that I can't afford to invest for impact. That's incredible information to have. The second thing that I think has changed is just, gosh, don't we have so much more information about what's harming the planet and how we interact with each other? I mean, it's one of the benefits of the information age. We can all be a lot more educated. And if you go back to, 20, 30 years ago, I just don't think we had the same kind of information about the impact that we were having on future generations.
It's funny. I had this in my notes for later in the conversation, but I'm going to jump to it now if you don't mind. Like this, part of the origin story of the financial advisor as a professional is information was scarce and hard to come by and expensive to access when it came to investments, right? And it's somewhat opaque almost on purpose, right? So make these products a little more complex than the average consumer understands. And the reason why we had what used to be called stockbrokers and then financial advisors was the average human being walking around, or average American, doesn't understand finance. They don't understand how these products fit with one another in a portfolio, how to manage one's asset allocation and so forth, and manage risk and so forth. So you needed a translator, if you were. You needed a guide to help you with this type of stuff. But kind of what you were just leaning into there a little bit as it related to impact investing is this information is out there now. It's becoming relatively easy to get to, right? Yeah. And so the consumer is changing, right? They're walking into your office. Here's a great example. I remember when the internet became real, right? Like, you and I entered the workforce and we were the last adults to enter the workforce before the internet was really a thing. But I remember when I bought a car. It was one of my first new cars after college. And I was in the workforce and I'm going to go buy a car. And I was able to go online and research the price of the car and look at what the dealer invoice was for the car. I had a new level of transparency on buying a car. And as a result, when I walked into there, I knew what I was going to pay. I had a very strong notion, no, I'm not going to negotiate really. This car with these options, this is what it costs. And if you don't sell it to me, I can go to the other dealership who has the same car and get it. That transformed the industry, right? We've seen a lot of that here in this industry as well, right? Consumers now have way more information. They just need somebody to corral them.
Yeah. Well, it's interesting. Not only do consumers have more information, they have the digital tools that help them interpret it. Yeah. So, no more would you be sitting with an investment professional and hearing about market volatility or standard deviation or the beta of your stock or any of those things. We can all go online and chart that stock and see how it's doing relative to the benchmark and understand the terminology in a very easy to digest way. And so what's happened in the industry is investors' expectations have gotten higher as it relates to the communications they have with their advisors and the tools that their advisors use. And instead, the conversations move towards goals. So all the investor typically cares about is being able to reach their goal. How they get there is important in terms of the impact they want to have and the beliefs that they have. But if they and their advisor can crystallize on their life goals, if they want to leave a legacy, how they want their kids to be able to go to school, the types of retirement that they want, that's what's important. And so that's the shift, that shift from investments to planning. That's the shift that really began to happen about 10 years ago and is happening even now. Now consumers want everything to be personalized. They want their investments to be personalized. They want their goals and life plans to be personalized. They want their digital experience to be personalized. I was reading a study with McKinsey, I think it was called On the Cusp. And the study was saying that, by 2030, 80% of investors will expect completely custom investment portfolios. And that's a huge shift. This idea before that, you invested in whatever your financial advisor recommended to you. You didn't even really know what a mutual fund was or an ETF or an alternative investment. Now let's talk about the goals and the instruments and the impact of the instruments. Now let's blow all that up and let's make it completely personal to me. It's possible and it's scalable and it's what clients expect. Just in the same way that you and I expect to be able to do our grocery shopping online and fill our cart exactly as we want it and order that Starbucks coffee with extra ice and half the cream and all of that. We all expect this now.
And it's such an important thing to think about. Part of the reason why we gave investors prepackaged, model portfolios or funds was it was the efficient way to do it, right? It was just, this is it was cost prohibitive to be able to do, like if I was an advisor and I had 150 clients, it was cost prohibitive for me to be able to manage all of those individual clients manually, their portfolios. Like, oh, okay. So, Natalie wants to make sure that the board of directors for every company that she invests in is diversified, has women representation, like all this type of stuff. Like that's very difficult for me to do as an advisor. But now the technologies are starting to catch up with like, no, we can do this actually.
Yeah. I mean, just think about how much friction there used to be to this. So, I'm a standard affluent investor. I have $250,000 in dollars to invest. I want to track to the market. 15 years ago, the transaction costs would have been really high. Mm-hmm. Because of the price of each equity in the S&P 500, I wouldn't have been able to track. There would have been tremendous tracking error in my portfolio. It would have been incredibly tax inefficient. And so mutual funds and ETFs, they solved all that. Right. You pool your investment, you can get access to the whole market. It's more tax efficient. It's easier to implement. There isn't the same kind of friction with costs. Well, all that friction's gone away with fractional shares and the ability to customize and transaction fees going to zero. Yeah. And so maybe the need for these pooled instruments are also going away.
So I love this conversation about removing friction from it, right? And the personalization. Like, it's funny. I was writing my show notes here. Like, we all expect Uber now. We expect Postmates, as you mentioned, curbside pickups for groceries. I can just, hey, you know what? Right. I'm going to go get groceries today, and I don't have to waste time walking around in the store and so forth. And I think it's easy for an advisor to be sitting there, especially one who's like maybe 60 years old, managing a couple $100 million AUM and going, all right, well, how am I supposed to do that? How am I supposed to translate to, I do need to bring on some of these younger clients. Some of them are the children of my affluent or high net worth clients that I already have. I need to be able to serve them. They're coming in with some new expectations that I'm not 100% sure I'm prepared to serve, to adjust to. What are some of the things that you would recommend an advisor does to kind of start to adjust to these types of expectations of the new investor?
Yeah, I mean, and these new investors, they not only want personalization and to vote with their portfolios, they're also interested in asset classes that are completely new. Right. We talked briefly about digital assets, but when groups of people can get together who have never met each other online and try and buy an original copy of the Constitution and raise enough money to get in second place, that's incredible. I mean, that's a degree of collaboration and cohesion that we've just never seen before. So, if you're an advisor, you're not only dealing with the degree to which the investment instruments themselves are changing and the friction's reducing. Also, there's whole new asset classes, right, or perspectives you're trying to understand. And what I would say is, this type of increased demand from your clients, as well as increasingly strict regulation, and the increasing demands for your clients to kind of meet them where they're at, versus you having a perspective and giving that perspective to the client, leads advisors to just need more time. Yeah. And that's really it's not about price with the advisors. If you are a great goal-based advisor and you have services to your clients that are meeting their needs, there's really no price sensitivity there, or price elasticity, I guess I should say there. It's really more about your time and your ability to scale these very custom services to your clients. And so that's why advisors outsource. They outsource so that they can redeploy their time from culling through thousands of investment options, learning about NFTs and cryptocurrency, figuring out how to custody those solutions, outsource that to somebody else. Yeah. And, hold them accountable and responsible for doing great things for you. And then redeploy that time to serving your clients.
I love that. Let's talk about outsourcing, because part of, it's what Asset Mark does, right? They do a lot. You do a lot of stuff. Right. I will talk about specifically about the things you do for advisors. But you just actually touched on one of the things that was fun. I was so glad we had this conversation in prep, because I said, don't be afraid to kind of push back on things or disagree with it, something I say, because, I'm not a genius over here. I'm just hosting the podcast. Right? But one of the common accepted concepts right now in our industry is that we're experiencing fee compression, that fees are coming down. And so that, and some people, we have seen it, when robo-advisors came in, there was a lot of concern, right, that they're pushing fees down and kind of what was going to be the new role of the advisor. And then I think we also see it because, as you mentioned, trading commissions went to zero, right? We have a lot of index funds now that are, a couple of basis points or zero. There's a few that are just charging no basis points now, right? So there's this massively, anxiety is the right word. Like, am I going to be able to continue to do this? But one of the things you were saying is like, no, we're not seeing that. We're actually seeing that advisor fees are pretty strong. Like, if people are willing to continue to pay for advice.
Yeah, it's interesting. There's no question there's pricing compression all over our industry. But if you array industry participants or array industry services in a value chain, with the closest to the client being the financial advisor and the furthest away being custody, capital markets, trading, you're seeing the compression the further away you get from the client. So in custody, there's been massive compression, although I would argue that custodians are being creative around spread revenue and payment for order flow and things like that. You're seeing, and then next to them is the asset managers. And you're seeing compression in asset management, particularly as the need for these forms are going away. The changes in terms of the sources of revenue and custodians has changed the value that the asset managers deliver. It used to be that there was value in the form itself in the mutual fund or the ETF. Right. Now there's less value, and so they're able to charge less. Also, those solution providers, they've consolidated and they're operating at massive scale.
Yeah.
So another, source of price pressure. And then you get to the outsourced providers like AssetMark and the technology. And there's been some compression there, 1 or 2 basis points a year for us. And we model that in because we want to make sure that there's value in what we do. And the next is the advisor. And the advisor is the person, the trusted ally of the investor. They're the person that says, okay, these are your spending habits. These are your goals in life. This is how much money you earn. These are your dreams and your aspirations. Let's put that on a roadmap. Right. And then let's check in on that roadmap. Let's check in on the investments that help you deliver that roadmap. There's such extreme value in that. We talked about the benefits of information. There's a drawback to information too. There's like thousands of times more information now at our fingertips, just on our phone, than in 1980. And it's overwhelming for investors. And they want that ally, that trusted person to help them navigate through all that information and focus on the goal. And so what I'm seeing with financial advisors, except for very, very, very large relationships, the ultra high net worth, there's been no pricing pressure. Now the services need to evolve, like the best advisor services need to evolve, but there hasn't been that kind of pricing pressure. In fact, advisors now, I was just talking to our business consulting team this morning, they're getting a lot of pricing review requests from advisors because they want to add services to their practices and charge for them separately. Yeah. And it looks like they have every ability to do that, to charge separately for a financial plan or charge separately for, a wellness visit or something like that. And so it's pretty interesting. It's pretty interesting what's happening right now.
I love it. We had Kieran Bowl on a show. He's from Price Metrics by McKinsey a few months ago. And he was saying the same thing. They had direct data from 70,000 advisors, and they're saying pricing is strong. It's actually very stable. And, part of exactly what you're talking about, people really value high quality financial advice, the more complex their life gets, right? So if we're still talking about, we go back to our Gen Z and our millennials, like as you grow and you start to get married, you have children, your job now has a bonus and stock option structure to it. You start going, hey, this is somewhat complex, right? Like I don't know if I know everything here that I need to know. And then I think anyone who starts investing on their own, sometimes you feel like you're a rock star genius, right? Oh, I bought Bitcoin at 2,500. Look at me, I'm a rock star. I know what I'm doing. And then the first time that whatever that investment is, whether it's Bitcoin or something else, loses 50%, and you're like, I have no idea. Should I sell it? Should I get back in? Like, what do I do here? And you start realizing maybe I'm not the steady hand at the wheel that I should be for my financial future. Maybe I should talk to somebody who actually knows what they're doing, or at least is emotionally detached, right? I always say that that's one of the most important roles of a financial advisor, is to be a kind of check on the emotions, right? A dispassionate guide.
Yeah, and a couple of things on that I think are really important. The first is, and you and I are old enough to remember this, all of a sudden in 2020, when things started to open up from the pandemic, because everyone was locked in their house, and so they were experimenting with trading and other things. But all of a sudden, when started having interactions with folks in 2020 again, I started hearing from friends and my kids' parents. Yeah, I've just decided to quit my job and I'm gonna trade. I'm gonna trade. I'm gonna trade crypto. I'm gonna trade equities. And I hadn't heard those types of interactions or seen that types of behavior since the late 90s.
Yeah,
where everyone was incredibly excited about what was happening. At that time, it was the .coms. This time, it's technology and also digital assets.
sure.
And what you realize is that type of behavior only pays off consistently in a certain type of market. And it just happened to be that last year was that kind of market. When the markets shift and the value of crypto goes down by 40% and that types of thing happens, often it's not an all or none conversation. People aren't all of a sudden saying, hey, this thing that I really enjoy and I get a lot of value out of, I'm going to stop doing entirely. Instead, what they say is, I'm going to bucket my money. I'm going to have money that I do my own trading for, that because I'm interested or because I need an income or whatever. And then I'm going to have this other bucket of money that secures my lifestyle.
Yeah.
And I think that's where advisors come in. You bifurcate kind of how you think about your investing, and advisors give you that security and that support so that that over the long haul, you'll be able to achieve your goals and your dreams. And so I think in 2022, that's the real opportunity advisors have in front of them. These new investors and the investors that maybe have taken a more active role in their portfolio, they're seeking advice. And for those advisors who are ready and willing to work with those clients and understand what they need, there's just a massive opportunity in front of them. 15% of investors. I mean, that's a lot of people, a lot of money. We haven't even talked about savings rates being so high.
Yeah.
Saving rates have never been higher. People are trying to figure out what to do with them, to do with those savings. Now's the time for advisors to really help them with that.
Yeah, it's 100% true. As a DIY investor, oftentimes you lack perspective and experience, historical perspective, right? So if you come into a market, as you were just talking about with crypto, where basically it's going up, yes, you see the dips and whatever, and everybody's like, buy the dip, right? And you feel like you're a genius. You're coming into some speculative plays here, and they're going great. Well, to your point, how much of your assets should you put in there? How much of your wealth should you expose to that? Because things don't always go up, and you've seen that. You've seen the dips, but what if this flames out spectacularly? How will you feel about that? It's funny, the story you talked about. We remember the late 90s. Mm-hmm. I was at a Christmas party, my mother's side of the family Christmas party, sitting there next to my uncle. And he's like, my buddy I work with, and my uncle worked at a printing company, a printing press. They made custom printing for brochures and so forth. And he's like, buddy I work with, he's thinking about quitting his job and becoming a day trader. I'm like, oh, that's interesting. He's like, well, look, he's been doing it a little while, buying the .com boom type stuff, and he's doing pretty good at it. And look, Mike, he doesn't want to make a lot of money. He just wants to make $100,000 a year. That's not that big of a deal. And I'm like, well, Larry, my uncle's name is Larry. In order to make, let's just say, if he makes on average 10%, because some trades are going to be losses, some are going to be. He's going to have to move $1 million of trades a year to make $100,000. So it was always interesting when you see a new investor who lacks some of these. If you've been trained in finance or trained in the investment process, you have perspective. You see this is what it's going to take to do that. This is what it's going to take to protect ourselves on the downside, right? So it's always sort of saving your client from themselves, I guess, is the overall message.
Yeah, and look, many asset classes that at one point, were considered new or innovative and were highly speculative, it can go two ways. They can be incredible and the basis for the future, or they can collapse. But at a certain point, not everything can be speculative.
Yeah.
It's intense pressure on the person who's doing the trading. And, you get to that point of market capitulation, and that's where panic sets in. Yeah. And that's where people really, set their whole life earnings back. And, we started this call with a conversation about the difference between millennials and Gen Z. Millennials have seen that twice. They saw it .com, and then they saw it with the financial crisis. Gen Z hasn't seen that yet. And it definitely shades how they view the markets.
Yeah. It's a really true. It's when you have experienced, and you and I have seen it basically 3 times, right? We saw the .com, and even before that, you saw the what was it called? In the early 90s, early to mid 90s, there was some rough moments before the .com boom set in too. Long-term capital, that's what it was, caused a big crisis there and so forth. Yeah. Anyway, we've got a lot of new investors in the space, but at the same time, we're hearing all this pressure on that advisors need to learn how to scale, and AssetMark plays a big role in that. How do you, being more specific, how does AssetMark work with advisors to help them scale and help them be more effective with their clients?
So there's 3 primary ways that we do this at AssetMark. And the first way we do this is we provide outsourced investment management services for advisors. And so all of the work that advisors do on security selection, constructing portfolios, keeping them in balance, trading the portfolios, managing the tax related to rebalancing the portfolios, all that work AssetMark can do for them. And what we do is we provide a set of solutions on our platform that are highly diligenced and highly curated. And the diligence saves them time culling through thousands of potential investment options. We narrow it down to the top 2 or 3. Mm-hmm. And in addition to that, it provides a real compliance benefit from advisors. They can use our diligence and our tools to align a portfolio to a client's risk capacity, which is really important from a compliance perspective. And it does that. We do that very seamlessly for advisors. The second is technology. Our technology is built for purpose for financial advisors to save them time and resources. We try to integrate the experience, reduce the number of clicks, reduce the amount of time so that they can align a client to a portfolio and then communicate that portfolio to a client in a seamless way. And then the other thing I'll say about our technology is we're really focused on making sure that it creates a great conversation between the advisor and their client. Not every client wants to interact with an advisor offline. So our tools need to make information about the portfolios available, beautiful. So a client always has comfort that the portfolio is doing what they expect it to do. And if the client has questions, they should be able to use our tool to ask the advisor questions so the advisor can either respond online or offline, depending on how the client would like the communications to proceed. And then the third way we outsource is we provide extraordinary service to advisors so that, we become part of their team. Yeah. They don't have to spend the time and resources hiring a lot of back office personnel, keeping track of the technology, managing the risks associated with the technology. And we're really known in the industry for that. And the sum total of that is advisors who outsource, 93% of them are much more satisfied after they outsource than before. They have a better lifestyle after they outsource than before. They save 7.9 hours a week if they outsource over 50% of their assets. And 81% of them have much better relationships with their clients because they can focus on what they do. And those statistics that I just cited are from our value of outsourcing study. And that study is among advisors who outsource and don't. There's 750 or so of them in the study and outsource to a variety of different providers. So there's definite value in outsourcing, especially if you're a smaller advisor, if you're less than 500 million.
Yeah.
Just the calls on the advisor's time because of the needs of the investors, the needs of regulation, how difficult it is to stay on top of industry-leading technology, that the calls and the time are increasing. And that's what's creating the need to outsourcing. It's not the price pressure. Yeah. It's just the amount of time, amount of hours in a day.
So I'm going to dive into so much of this stuff, right? I hope you don't mind. It's lighting me up because I nerd out on this type of stuff. So one of the things you mentioned, what it does for the client is giving the client the ability to interact with you either asynchronously or digitally, or not have to be offline or on the phone. We've been talking about the changes and in respects to younger investors. We actually see this with older investors too, Gen X and Boomers, right? So I always bring my parents into this because it's just my dad just turned 70, and So I have young parents, for my age, but something happened in the last decade where his preferred means of communication with me went to texting or Facebook Messenger, right? Versus calling me and talking to me on the phone and so forth. And if that's happening with, a 70-year-old, imagine what's happening with your younger folks who their whole world, they walk around with a phone, and we all do it, but have a phone in their hand at all times. And their preferred way of interacting with the world is with their phone, right? Because it's like, I get information instantly. I can send you a text and you can get back to me when it works for you. And or I can go get the information I need to via some sort of AI-driven chat bot that tells me what I need to know, and I go find that type of stuff. I think it's fascinating that there are times where I go on a chatbot thing. I'm like, I'm going to try this first before I call, before I do anything else. And I would love for this just to give me an answer so I don't have to talk to a human. Mm-hmm. Like, believe it or not, I don't want to talk to a person right now. And the fact that you're offering that type of solution is wonderful for the client experience.
Yeah, it's interesting, in all of our lives, there's a recency effect. The minute I think about something funny to share with my mom, my daughter does something funny, and you want to share it with your mom, you can do it. You don't have to wait and plan for it or remember it, hours or days later. I joke with my kids about, you used to have to get money from banks. Yeah. You used to have to actually go into the branch, stand in line, get money from banks. And, that just blows their mind that you didn't have access to your own money whenever you wanted it. Well, the text and the phone is another example of that. You can communicate when it's top of mind, when something's funny or fresh. And even if you or I can't respond to it right away, they know we'll see it and we'll respond to it, when it's convenient for us. I am absolutely fascinated by this concept of asynchronicity, where you engage with something when it's meaningful for you and somebody gives you their best response when it's meaningful for them. Right. As it relates to the whole workforce and the fact that we've been more remote for these last 2 years, I think the ultimate answer is going to be something more hybrid in fashion. Sure. But we all have to bring this asynchronous thinking and working into our workforce, into our product offerings, into everything we do. Because at the end of the day, it's meaningful. Like if your dad can pick up his phone and tell you something important to him and not take the risk of forgetting it or not take the risk of forgetting exactly how it happened, that's a meaningful benefit. That innovation happens that way. Yeah. It also happens when people get together and collaborate. So you have to do both. You have to be able to do both.
But what's interesting too is we've had similar transition periods like this before, inflection points, if you will, for advisors, right? So again, because of our generation, we're old enough to remember when advisors were first getting emails and first getting websites. And some of them would look at you like, why would I need an email? Like, I talk to my clients on the phone and I send them statements and so forth. Like, it's like people are going to want to communicate with you this way. Or why would I need a website? My clients all know where I am. Like, you're going to want a website. And then it was like, it's going to need to be a little more than just a static brochure style page. There's going to have to be something to it, a little more. Or you're going to want to be on LinkedIn. Why? Your clients are going to want to be on LinkedIn, right? Like all this stuff. So we see this. Now, some of those are really relatively inexpensive for an advisor to, especially if we're talking about a solo advisor or a small shop, right? Relatively inexpensive for them to do on their own. I can get a website up. I can, set up my own email server, all that type of stuff using Google Docs or whatever it is that they use. But some of the stuff you were just talking about is more complex, requires more horsepower, if you will, more knowledge. And you were talking about that, and when you were describing some of the things that AssetMark does from an outsourcing perspective, that you're helping, and this is what we talked about in our prep call, I love this, helping advisors kind of transition from having a solo practice, if you will, to being a real business, right? Because it takes horsepower. It takes, expertise in a variety of different areas that a small shop advisory firm is not going to be able to bring all that stuff in-house. Right. That's right.
And, that is the opportunity. Like for me, I'm really excited about it as someone who provides outsourcing services to advisors and wants to make a difference in their lives every day. It's a huge opportunity for AssetMark to build a financial wellness offering that streamlines and enhances the client's conversation with their advisors, because these small independent businesses, they just can't invest at that scale. You have the investment made, though, it could just really propel growth. And again, I couldn't be more excited about the industry right now. I think we're finally going to meet our investors where they're at and where their needs are, which is just fantastic because we have an industry of trust. And the more you're meeting the investor where they're at, the more they trust you, the more they want to invest for the long term. And that's great for everyone. Investing for the long term enhances people's ability to reach their goals and achieve their dreams. And so I'm extremely excited about this inflection point. The other thing I'm excited about is there's a lot of new entrants into, broadly speaking, advice. If you look at the CFP, the CFP board just issued a press release. Their class of 2021 has never been more diverse. There's never been more women. It's young. These people are enthusiastic about doing great things and changing the industry. It doesn't mean that the older advisors aren't as enthusiastic about doing great things as the new generation, but it's great to see as advisors retire, this next generation being interested and attracted to what we can do for investors. It's good times. Really good times.
I agree with you. That's wonderful. And it's kind of almost a great way for us to wrap up because I know we're running towards the end of our time here, but we've talked mostly about the client here and how advisors can better serve the client. But you would just, put your finger on something. I think that's incredibly important here. We talk a lot about it on the show is advisor succession, right? And in order to have good advisor succession, you're going to have to fill with younger advisors are most likely going to be the ones who take over. We talk about the average age of an advisor 62-ish around right now. It's like, well, that means we're going to have to get some young people. But we've heard some grumbling, if you want to call it, that many younger folks don't want to come into this industry or whatever. They're not finding the financial industry attractive. Well, maybe it's because of the way that things were being done, but with so much more technology, some more innovative approaches to doing the business, and the industry getting more attuned to the things we were just talking about personalization, about asynchronous communication with your clients is okay. It actually starts to seem more attractive. What are you seeing in terms of you mentioned getting more diverse in the CFP? Are you seeing new ways of attracting advisors to firms that or developing new first-time advisors?
Yeah, so the first thing I would just say is a challenge for the independent advice industry generally is the misperceptions are just huge. So if you talk to somebody who doesn't know anything about independent advice, young person in college, and they're thinking about their career, the first thing that they will say is, oh, that's sales. And I don't want to do sales. I don't want to be a broker. There's just this perception that it's sales, and then what you're selling might not be in the best interest of the investor. And you and I both know that nothing could be further from the truth.
Right.
But this idea of Gordon Gekko, stock jock, it's pervasive. The misperceptions about it are pervasive, even though the industry moved beyond that decades ago.
Right.
And so starting financial planning programs at colleges and universities, educating young, early career entrants on what this industry is and what you can accomplish. If you were to ask a Gen Z person, you were to ask a young adult, do you want a career where you can make a positive impact on the financial lives of folks in your community, where you can help shape the investments that are made in the future in our environment, where you can have a career that allows you to have a lifestyle, some independence about what hours you work and how you work? They would say, yes, let me have that. Right. That sounds perfect. But they don't associate that with financial advice. And so, CFP board is trying to change those perceptions. Colleges and universities, they're trying to increase education about financial advice. Other advisors are trying to educate in their community. It's funny. We have a big event coming up at AssetMark, and this event, we took videos of investors that are served by our advisors. And the video is actually really inspiring. And one of the things the investor said is, I just feel comfortable spending my money. I feel comfortable that I'm on track. I feel comfortable that my kids will be okay, just over and over again. And at the end of that whole session, everyone who was recording or interviewing or putting makeup on, all of them are like, I want an advisor. And it's just, there's not an awareness that this ability, this type of advisor is out there and has services that are right for them. And so I just think we need to do a much better job about awareness, because the industry is fantastic and advisors are fantastic. They really care. They're trusted, I'd say allies. Yeah. They're trusted allies. And don't we all need a few of those? So
yeah, I love the way that you put that, you know, you have to get to have a positive impact on people's lives. And, you know, I would build onto that. Like, listen, there's a lot of young people who are wondering, like, what kind of career can I have where I have a stable, you know, income and one where I can achieve a lot of my own financial goals, my career. It's like, this is a very vibrant industry. To the point you made, you're highlighting.
You can be an entrepreneur.
Yeah,
you can be an entrepreneur. You know, that's I should have said that, but you're right. Yeah. You can have a great living and be an entrepreneur, and there's so many great things.
And nobody's laying you off from this. It's great recurring revenue in most models. You know, like you said, you have a great impact. And here's the other cool thing: it is not saturated. This market is not saturated. In fact, it's actually understaffed. The number of Americans who don't have an advisor is like somewhere in the neighborhood of like 75% of Americans do not have a financial advisor. It's really, really high. And so like, that means just about everybody you know can use a financial advisor. Just everybody you meet, right? So fantastic industry.
So one last thing that I think is important to say, we've talked a lot about the younger generation of investors and advisors. And one thing I just also want to say is advisors love what they do and they're great at it. And, you know, it's quite common because advisors are, you know, working with individuals in their communities that retirement isn't something they're interested in a classical way.
Right.
You know, so while the average age of advisor is 62, if you love what you do and you're great at it and you're able to help your, you know, friends and your community members achieve their dreams, that's not something you want to turn off like a switch. Right. And so I just think it's important to understand that, you know, the older advisors, I don't know that we're going to see the mass exodus overnight that people have been predicting for many years. What I really want to see is these older advisors continuing to do the great work they're doing and then, you know, fostering an apprenticeship culture with these new advisors that come in to the market, so that the overall the number of advisors expand.
Yeah,
I'd love to see that.
I agree. It'd be wonderful, and it should be that way, right? I mean, again, it's a fantastic business. You get to have a big impact. You get to stay engaged with people, and that's, you know, and if you're doing it right, in my opinion, you're also staying innovative, right? You're always on the cutting edge of like what's happening. Like I've been in this industry my entire career, which, you know, now is over 25 years, right? And you said like, it never gets old. There's always something new, right? So it's like, it's not like, it's the same boring crap I've been seeing for 20 years. Like, no, it's like really, really innovative and cool stuff happening. There's always a new way to serve clients. There's always new innovative products and investments. So fantastic stuff.
And we're still, I mean, you mentioned we're at an inflection point, and I truly believe we are, but we're at the early stages of that inflection point. Sure. There's still so much great work ahead of us. There's so much opportunity ahead of us. So, you know, I was talking to my head of investments the other day, and I'm like, our industry is kind of at the Model T stage, and our life is at the Tesla stage. You know, with these pooled instruments, you can have your car any way you want it as long as it's black. You can have your mutual fund any way you want it as long as you pick a mutual fund or an ETF. That's going away, but it's at the early stages of that. And I just think that's exciting. It's exciting to make the change.
That is really exciting. I'm glad that's a fantastic analogy to make, the Model T, and then all of a sudden you have all these different customizations with cars, and it's the same thing here with our financial lives. Well, Natalie, this has been a fantastic conversation. I love this. I'm going to have you on the show again. You're such a delight to talk to. I am sure that folks are going to want to follow up with you. What's the best way for people to get in touch with you and hang out?
You know, the best way for folks to get in touch with me is to just reach out to AssetMark.
Okay.
You know, www.assetmark.com. To reach out to one of our sales or relationship management team. You can also find me on LinkedIn, and I would love to talk to you.
Fantastic. Well, thank you so very much for coming on the show. This is fantastic.
Okay, thank you. And I would love to do this again. I love to have these conversations. I learned quite a bit today from you about, like, for example, the amount of Americans that don't have advice. I haven't looked at that statistic, and that's really incredible. It's really incredible.
Frightening is not the right word. It's fascinating, right? So I did an earlier episode. It was actually a solo episode of the podcast years ago. And I was saying, hey, listen, look beyond the 1%, because a lot of advisors are looking for the 1%ers, right? They're looking for high net worth or ultra high net worth relationships. And it does make sense based on the models that many advisors have for operating their business. Like, listen, I'd rather serve, 100 clients who all have, $10 million each. And I'm doing very well for myself based on my AUM model. But a lot of advisors bang their heads against the wall. You see, like, constantly in the chats and the forums for new advisors, like, how do I find clients? Like, it's something they struggle with. And it's like, everywhere you look, there's people who don't have financial advisors, like everywhere you go, right? Like, yes, some of them are going to be smaller AUM to manage at the beginning, but they're there.
Yeah, but I would argue that if you can change your fee structure a little bit, so maybe a fee for service rather than AUM when the clients are smaller, and we can scale this industry, we can provide those electronic and asynchronous tools. Why not? The barriers to serve those clients are gone. That's just fantastic. That would be fantastic.
I'm so glad you said that. We went over, but that's fantastic. I want to keep going on this. No, it's true. Like this, it goes back to what we were talking about earlier on in the conversation, right? It was cost prohibitive because of the manual labor involved in order to have a custom portfolio or whatever. But some of these tools, and I'll even lump in some of the robo advisory offerings that an advisor can employ in his or her business to manage some of the stuff, or the asset mark services that can manage all these assets and do some of the things in the back end that you don't have to do. It's alleviated that problem. So you can scale yourself and serve people without having to charge or worry about that. Hey, 100 basis points for a client who only has $100,000 is only $1,000 a year in revenue for me. It's like, okay, well, that's true, but you don't have to do as much work for that anymore. Right. And so you might be able to serve them a lot better, right? And grow them over time.
That's right. And this generation next, this next generation of investors, this next generation of consumers, they're open to that. They're open to, not doing banking with a bank, but instead, person to person. They naturally want to engage in an asynchronous way, which is not just more relevant and meaningful to the investor, but also more convenient and scalable for the advisor. The industry's ready. I mean, we're ready, and we all need to evolve. We all need to continue to innovate. But I think we're ready for this change. Meaning, participants in the industry want it. It's the right thing to do. So,
100% agree. 100% agree. Well, in closing again, Natalie, this has been a wonderful conversation. Thank you so very much for joining me.
Thank you. Really good to talk to you.
Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to Natalie Wolfson. It was fantastic to get to know her and spend some time with her. I really enjoyed this conversation, and kind of anytime I get the opportunity to noodle on like the future of the industry and the future of kind of how people are interacting with the world, love to do it. So this is awesome, awesome stuff. As I mentioned at the top of the show, if you have not done so already, please do make sure you subscribe to the podcast. And if you liked this episode of the show, give it a share with your network. Click the little share button on wherever you saw or listened to this podcast. You can just do that, right? Share it with your friend. LinkedIn, Twitter, Facebook, wherever you like to share stuff, go ahead and do that, all right? If you liked it, your network will like it. So let them know about this podcast. All right, that's all I have for you today. Make sure you're staying safe and be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya.